The slowdown primarily reflects a cooling in the housing market. Most other sectors of the economy appear still to be expanding at a solid rate, and the labor market has tightened further. Inflation, which picked up earlier this year, has been somewhat better behaved of late. Overall inflation was pushed up this spring by a surge in energy prices, but the recent declines in energy prices have largely reversed those effects. Price inflation for consumer goods and services, excluding energy and food, the so-called core inflation rate, has also moderated a bit in the past few months, but the level of core inflation remains uncomfortably high. Although residential construction continues to sag, some indications suggest that the rate of home purchase may be stabilizing, perhaps in response to modest declines in mortgage interest rates over the past few months and to lower prices in some markets. Sales of new homes ticked up in August and increased a bit further in September. The University of Michigan survey of consumers shows an increase in the share of respondents who believe that now is a good time to buy a house, from 57% in September to 67% in November. Meanwhile, an index of applications for mortgages for home purchases has been trending upward since July. Although these developments are encouraging, we should keep in mind that even if demand stabilizes at its current range, reducing the inventory of unsold homes to more normal levels will likely involve further adjustments in production. The slowing pace of residential construction is likely to be a drag on economic growth into next year. However, as with the outlook for economic activity, there are substantial uncertainties about the inflation forecast. In the case of inflation, the risks to the forecast seem primarily to the upside. Given the current level of inflation, a failure of inflation to moderate as expected would be especially troublesome.